Welcome back to another exciting episode of Prime Charts. Today, we're diving into something special, the candle range theory, an advanced concept that could seriously boost your win rate. Imagine having the skills to predict upcoming price movements and candle formations before they even unfold on the charts. With this powerful trading strategy, you'll gain insights to align yourself with institutional money instead of trading against it. So, make sure to stay tuned, watch every minute, and let's unlock the secrets of the candle range theory together. So, without wasting any time, let's dive in. Let us start with the basics. What exactly is CRT? The CRT trading strategy is based on the theory that every candle on the chart represents a range. That means a single candle on a higher time frame actually equates to a range of smaller candles on a lower time frame. Alright, let's take a look at this candlestick right here. First, we see the opening. This is where the candle started. Down below, we have the closing, marking where the candle ended. At the top, there's a wick, and there's also one at the bottom. Let's go ahead and mark the top wick as our CRH, candle range high, which represents our high point. If this is a daily candlestick, that's the high of the day. Down below, we'll mark the bottom wick as our CRL, candle range low, which is our low of the day. Now, over to the left, we can see that this single candlestick is a candlestick on a higher time frame, and it represents a range of smaller candles if we zoom into a lower time frame. You'll notice price moving up in smaller time frames within this big candlestick. And in a smaller time frame, this big candle is broken down into a series of smaller candles moving up and down. And from here we expect the price to drop down toward the CRL. Moving on to liquidity, we've got our high marked as CRH and our low marked as CRL. When either the high or low gets swept, the price usually moves to the opposite wick. For example, if the price sweeps the top, it's likely to move downwards. Here, you can see the price swept liquidity at the top and then dropped all the way down. Now, let's look at three candlesticks together, which illustrate the power of three. The first candle shows accumulation, where price builds up. The second candle, manipulation, tricks traders by breaking the high and then quickly moving back into the range, catching many off guard. The third candle, distribution, shows price moving down. This is the candle we want to trade, it's where the real move happens. In a bearish scenario, the candlestick-based CRT typically involves a sequence of three candles on a higher time frame. Here's how it plays out. The first candle establishes a range with its high and low. The second candle then takes out liquidity by sweeping the high of the first candle with a wick. The third candle breaks out of this range, often signaling a bearish movement. It's essential to note that the CRT model doesn't always limit itself to just three candles. Sometimes, it might take more than three to form, especially in longer setups. The main difference is that a three-candle sequence usually forms over a shorter period, but the principle holds whether it's three candles or more. For example, in this series, we see multiple candles forming to reach the range high, making a series of higher highs and higher lows going to the upside. And we see the second candle in a lower time frame sweeping the liquidity resting above the high of the previous candle. And price started dropping to the downside after sweeping liquidity. This is a perfect demonstration of the candle range theory in a smaller time frame. These principles apply to both bullish and bearish markets. You can use them across different time frames and on any price action-based chart. When working with CRT, it's important to choose the right entry time frame based on the chart where you've identified the CRT range. Here's a quick guide. If you identify a CRT range on the monthly time frame, look for entries on the daily time frame. For a CRT on the daily chart, you'll want to execute your trade on the 1-hour time frame. When your CRT is set on the 4-hour time frame, then entries should be made on the 15-minute time frame. If your CRT is identified on the 1-hour chart, use the 5-minute or 1-minute time frame for precise entries. Finally, if your CRT is on the 15-minute time frame, you'll use the 1-minute chart for your buy or sell decisions. Now, let's dive into how to use the CRT model strategically to improve our entries and capitalize on profitable trades. Looking at this example, we see this area as the opening price. Let us shift our focus to the second example over here. We also notice the opening of the third candle here. This is the distribution candle, and therefore, we are looking for selling opportunities after price has taken out the liquidity. We then place our sell order above the open of the third candle. We are going to sell above the opening of the previous candle because we want price to retrace back to an order block or a fair value gap, giving us a clear confirmation to sell the market. Let us look at the final example on the right side. This example is in a lower time frame marked with a CRH and a CRL, our candle range high and low. In smaller time frames, this appears as a range of smaller candles moving up. After sweeping the liquidity above, we expect price to return to the range, potentially signaling a shift as sellers come in and push the market down. Once we see a market structure shift, price will likely retrace back to an order block or fair value gap before we enter. Here's an example with gold on the daily time frame. We've marked the previous high and low, and on a smaller time frame, this big daily candle appears as a sequence of smaller candles moving up. As price reaches the previous high, it sweeps liquidity and moves back into the range. With a market structure shift indicating sellers are stepping in, we can set our sell limit as price retraces to a fair value gap or order block. Lastly, remember that CRT is about precision and patience. Sometimes you might miss a trade rather than lose one. That's okay. It's about quality setups. Let's take a look at another example. In this example, we have marked our CRTs on 4 hours time frame. On a lower time frame, we notice a market structure shift down below and a fair value gap above. And therefore, we can place our sell orders and wait for price to activate the sell orders. Price has dropped to the downside without activating the sell orders we have placed earlier. This was a demonstration that not every good setup will make a good trade. Always stay positive when trading the market. Let's take a look at another example. We have marked our highs and lows on a daily time frame. On 4 hours time frame, we notice that price has already taken out the liquidity above the previous high. If you scale down to a 15 minutes time frame, you can clearly notice a market structure shift down here, confirming that the seller are ready to step in and take control. Up there, we notice an order block and we mark it, anticipating price to tap into the order block and start dropping to the downside. So keep back testing this strategy, familiarize yourself with it, and with practice, you're set to see great results in the market. Stay positive, keep practicing, and I'll catch you in the next video.